Welcome back to Explain the Charts, where we dissect the data behind the moves. Today is March 25th, 2026, and the Nasdaq 100, tracked by the QQQ, is currently facing one of its most complex environments in years. The primary driver of recent volatility is the ongoing conflict in Iran, which has intensified with the deployment of 3,000 U.S. troops to the region. This geopolitical uncertainty has pushed West Texas Intermediate oil over $91 and Brent crude toward $104. Energy price surges like this act as a direct tax on growth, which is why we are seeing tech stocks underperform. Compounding this, the tech sector is reeling from the Supermicro AI chip fraud case involving smuggling to China. Traders are also bracing for Jerome Powell's Fed decision, with inflation fears curbing hopes for much-needed rate cuts. As we look at the big picture, the S&P 500 has recently triggered a warning signal by dropping below its 200-day moving average. Nasdaq futures are showing some relief on ceasefire hopes, but the overhead resistance remains heavy. In this video, we will correlate these global events directly to the candlestick patterns appearing on your screen. Starting with the daily chart, we can see the long-term uptrend that peaked back in late October 2025 near $635. Since that peak, the QQQ has been forming a series of lower highs and lower lows, indicating a transition into a corrective phase. Notice the massive red candle on November 15, 2024, which initially signaled that the parabolic move was over. Throughout early 2026, we see the index attempting to hold the $600 psychological level. However, the most recent data shows a breakdown from the March 10th high of $607 down to our current levels near $584. This 4% slide in just 2 weeks correlates perfectly with the escalation of hostilities in the Middle East. The volume bars at the bottom show significant spikes during these down days, suggesting institutional distribution. We are currently trading significantly below the early March highs, and the $580 level is proving to be critical support. If the daily close fails to hold $580, we could see a fast move toward the $560 support zone established in mid-2025. The trapdoor mentioned in recent financial news is visible here as we lose the support of previous consolidation zones. Switching over to the 1-hour chart, the short-term bearish trend becomes even more evident. Each relief rally over the last 2 weeks has been met with aggressive selling into the $610 to $612 range. On March 4th, we saw the QQQ peak at $612.88 before being rejected harshly. The hourly candles show a consistent pattern of selling the news, where any mention of ceasefire is used as liquidity to exit positions. Specifically, look at the price action on March 20th, where the index slid nearly 2% as oil moved above $110. The subsequent bounce on March 23rd followed President Trump's announcement of a strike postponement. However, that rally stalled at $603, creating a lower high on the hourly time frame. This inability to reclaim previous support levels is a hallmark of a bearish market structure. The VWP, or volume-weighted average price, has been trending downward, keeping a lid on any intraday price appreciation. For the bulls to take control, we need to see a series of hourly closes back above $600 with expanding volume. Now let's zoom in on the 15-minute chart to see how the market is reacting to the intraday headlines from March 24th. The open at $591 was immediately sold down to $584 by midday as Iran denied de-escalation talks. Notice the high-volume clusters near the 582 support level around 1952 Universal Time coordinated on March 23rd. This area acted as a floor where buyers stepped in, likely covering shorts ahead of the Asian market open. However, the rally back to $590 at the end of the session on March 24th looks like a classic dead cat bounce. The 15-minute chart shows a massive resistance block at $592 where the QQQ failed multiple times. This $592 level is the key line in the sand for intraday traders today. If we stay below $590, the path of least resistance remains to the downside. The volatility during the triple witching options expiration is clearly visible in the elongated wicks of these candles. Traders should be cautious of these fake-out moves that occur right after major news alerts. Analyzing the volume profile, we see that most of the trading is occurring in the 585 to 595 range. This high-volume node suggests that the market is in a period of price discovery, waiting for the next big catalyst. The bearish case is reinforced by the rising producer price index, which grew by 0.7% in February. This structural inflation, driven by tariffs and energy, makes it very difficult for the Fed to pivot to lower rates. On the bullish side, if a 5-day suspension of strikes turns into a permanent ceasefire, oil could plummet back toward $80. A sharp drop in oil would likely spark a massive short squeeze in the QQQ, as seen in previous relief rallies. However, the technicals currently favor the bears as long as we remain below the 200-day moving average. We are also seeing a rotation out of tech and into energy stocks like the XLE, which is a defensive posture. Apple's projected market share gain is a bright spot, but it may not be enough to lift the entire index. The SMCI scandal remains a localized tech risk, but it weighs on the general sentiment of the AI ecosystem. To recap, our primary resistance levels are 592, 603, and the major psychological barrier at 612. Our key support levels to watch are 582, 578, and the long-term support at 560. I believe there is a 65% likelihood that we test the 575 to 578 range in the next week if no ceasefire is signed. This prediction is reinforced by the persistent high oil prices and the risk-off sentiment before the Fed meeting. There is a 35% chance of a relief rally to 605 if diplomatic talks with Iran show verifiable progress. Keep a close eye on the 10-year bond yields. If they continue to rise alongside oil, tech will face further pressure. Also, watch for the earnings reports from PDD Holdings, which could influence the broader retail and tech sentiment. The market is looking cheap for the first time in a year according to some analysts, but cheap can always get cheaper. Always wait for a confirmed candle close above resistance or below support before entering a major position. Consistency and risk management are your best tools when the headlines are driving the charts. In summary, the QQQ is at a critical crossroads where geopolitics and technicals collide. The trend is currently bearish on the daily and hourly timeframes, necessitating caution for long-term investors. Short-term traders should focus on the 582 and 592 levels for high-probability setups. Thank you for watching Explain the Charts. Please like and subscribe if you found this analysis helpful. Remember, this video is for educational purposes only and does not constitute financial advice. Investing in the stock market involves significant risk, and you should always conduct your own research. Consult with a licensed financial advisor before making any investment decisions. Market conditions can change rapidly, and past performance is never a guarantee of future results. Stay disciplined, watch the levels, and we will see you in the next chart breakdown. Good luck with your trades and stay safe out there.